Imagine a world where the cost of living keeps rising and the purchasing power of your money seems to shrink. Many investors seek ways to shield their portfolios during such times, wondering if certain assets can act as a reliable buffer. Yes, infrastructure investments can indeed offer a degree of inflation protection, though the extent of this protection varies significantly depending on the specific asset and its underlying characteristics. The core mechanism behind this protective quality lies in the nature of infrastructure assets. These are typically long-lived, essential assets like toll roads, utility grids, airports, or communication towers that provide services critical to daily life and economic activity. Many infrastructure projects benefit from revenue streams that are contractually linked to inflation, meaning their prices can automatically adjust upwards with rising costs. This direct indexation, or the ability to pass through higher operational expenses to customers, helps maintain real returns. Furthermore, the high barriers to entry for new infrastructure projects often grant existing assets significant pricing power, allowing them to raise fees in line with broader economic inflation without losing market share. This inherent demand, resilience, and regulatory frameworks, which sometimes permit cost pass-through, contribute substantially to their inflation hedging capabilities. To assess the inflation protection of a specific infrastructure investment, one should closely examine its contractual arrangements and regulatory environment. Look for explicit inflation indexing clauses in concession agreements or tariffs that allow for automatic price adjustments based on consumer price index or other inflation metrics. Also, understand the demand inelasticity of the service provided, as assets that offer essential services tend to have greater pricing power during inflationary periods. Finally, consider the asset's operating leverage. Those with lower variable costs and higher fixed costs are generally better positioned. It is also valuable to distinguish between core infrastructure assets, which typically have strong regulated or contractual inflation linkages, and opportunistic infrastructure, which might carry more direct exposure to economic cycles. Publicly traded infrastructure funds, or exchange-traded funds, can offer diversified exposure, but their stock prices may exhibit short-term volatility, not directly tied to the underlying asset's inflation protection. Understanding the directness of inflation pass-through is key to harnessing their full protective potential. By carefully selecting infrastructure assets with robust inflation-linked revenues and essential service characteristics, investors can integrate a valuable component into their portfolios. This approach can help preserve purchasing power and contribute to more stable real returns, offering a strategic defense against the corrosive effects of rising prices on investment capital over the long term.